Good afternoon, everybody. Welcome once again to the weekly live webinar presented by Affinity Federal Credit Union. Today's topic is borrowing basics, understanding loans, rates, and credit. My name is Oscar Cordova, and I'm the External Affairs Manager as well as Financial Education Manager for Affinity Federal Credit Union. I manage the financial education efforts of the credit union in all of the areas that we cover, that we serve. Before we begin, I would like to go over this brief disclaimer. The disclaimer states that all of the information provided to you guys this afternoon is intended to be for information purposes. It's intended to be educational. It is not intended to be legal, tax, or financial advice. Every person's circumstances are different, and if you want to talk to a professional, tax consultant, financial professional, or legal counsel, feel free to reach out, and I'll be more than happy to put you in touch with somebody that can have a one-on-one conversation with you and can advise and help you in what you want to discuss, right? All right, so let's get the ball rolling. All loans in the eyes of the honest borrowers must eventually be repaid. All credit is debt, said by Henry Hazlitt, and he's a journalist for the Wall Street Journal, Business and Economics. And this quote rings very true because perhaps not someone at a later age, but someone in college. And it happened to me. When I first got my first credit card, I didn't really understand what it was. And I thought it was that the bank was allowing me to use money, but I didn't put two and two together that eventually the money needs to be repaid. And since I didn't know that, I got into trouble very early in my life financially. Also, when I found out that there was interest to be paid, that was something else that I got a pretty rude awakening on credit, on interest, on paying on time. So we need to keep that in mind, right? Even though this webinar is designed to give us the information and the perspective on what borrowing is, we need to keep in mind that eventually all money that we borrow needs to be repaid back. It's not free money, right? It's not our money. It's eventually the credit unions or the banks or the credit card companies' money, and we need to pay it back. So what is credit? Credit is money borrowed, as I just stated, commonly referred to as a loan. Credit is the promise to pay back the money borrowed plus interest. And there are different forms of credit. Secure loans, and we'll go into more in detail on each one of these. Unsecured loans, fixed rates, adjustable rates, and revolving loans, okay? Now, I've met through my 25-year career in the financial industry, I've met a couple of people throughout my years in banking that have never owned a piece of credit in their life. They've always paid everything in cash. And so it was actually impressive to see how everything that they've been able to acquire, it's because they saved up. And in order for you to, for example, a house, if you're going to buy a property, you need to save up a lot of money if you don't want to use a loan. If you don't want to finance a piece of the property, you need to save up a lot. And I saw, and I met these people throughout my career, and I can only admire them, because that means that they were very disciplined. They were very on top of their finances, saving towards their financial goals. So that's kind of like, if somebody knows how to save, will be those kinds of people. But I want to say 9.9 out of 10 people out there, we eventually are going to need the help of a financial institution in order for us to purchase those things that we need, right? So the importance of credit. So credit, as mentioned here, credit is useful in times of an emergency. As I mentioned before, a couple of weeks back, I presented, actually last week, I think it was, the budgeting basic. And I spoke about an emergency fund, which is having an account, a savings account where we can put some money away for that rainy day, for that day that we wake up and we have an emergency and now we have something saved up. But in case we don't have that emergency fund in place right now, having a credit card is useful because it's going to help us get out of that tight situation, that emergency, without having to ask a family member or a parent or a friend for money to get out of the emergency. So having a credit card allows us to buy something now and pay for it later. And so in this case, having a credit card for an emergency, it can be very useful. Credit can be more convenient than carrying cash. And this is very true. Not a lot of people nowadays carry cash. Most people prefer to carry their debit card or a credit card. And the reason is because, well, one of the reasons is because if you lose your debit card or your credit card, there is recourse. There is some kind of way for you to get the money back. Where if you only carry cash and you lose that cash, well, that's good. Guess what? You're out of luck. There is no way you can get the money back. Okay. And as I was just mentioning before, allows one to make larger purchases such as a car or a house, because having credit, and not only having credit, having good credit. And what does that mean? Having good credit is paying on time, not being late, keeping your balances versus your limits low, and preferable under 30% of your limit. So real quick, if you have a credit card for $1,000 limit, you want to maintain your balances around $300 or less. And this will create the best score on your credit profile, okay? So having good credit will open the door for us for financing on those larger purchases, such as a vehicle or a property, right? So forms of credit. There's a couple of different forms of credit. One of them is a secure loan and an unsecured loan. Determining if a loan is secure or versus unsecured is as simple as determining if there's collateral involved. And what's collateral? Collateral is something of value that can be put up as a way to give the lender some kind of recourse in the event that we don't pay our loan back, right? So, for example, the loan is secure if there's collateral involved, such as a home, auto, or cash. If we have that kind of collateral or valuable items securing the loan, means that if we don't end up not making payments, or we decide that, for example, it happened a lot of people in the pandemic, they lost their job and now they cannot make payments. The bank will start the process to foreclose on the property, or they will repossess the vehicle. And so at the end of the day, everybody loses, because a bank, when they foreclose on a property and they take the property away from the borrowers, at the end of the day, the bank has no use for the actual property. What the bank or the credit union or the financial institution needs is the interest that the property generates through the form of payments from the borrower, not the actual house. So whenever a financial institution repossesses on a house, yes, eventually they'll put it back on the market and try to get some money from the sale to satisfy hopefully the whole loan, or if not, at least a piece of it. But while that happens, the financial institution has to pay for the upkeep of the property. And not only that, they're not receiving any more payments from the borrowers. So at the end of the day, the borrower loses because they lose their home. but the financial institution loses as well because now they have to start making payments on upkeep, and they're not receiving any interest payments or payments from the borrower anymore. Okay. An unsecured loan are loans without collateral, and those are kind of loans such as personal loans or credit cards. Most credit cards, you don't need to put up anything of value for the loan. You apply, and based on your credit score and your income, you get approved. And a credit card is, they allow you to use the bank's or the financial institution's money up to a certain limit, and then you just need to pay the money used back plus interest. With credit cards, you guys have to be very careful because, you know, many people get sucked into the different offers that they get. So they may get an offer in the mail saying, get this credit card, a year without interest, 18 months, no interest. And people are just thinking about that time of that they don't have to pay interest. They don't have to pay anything back. Whatever they use, they pay back, and that's that, right? But many people fail to understand what are the terms and conditions of the card after the promotional period. And so, unfortunately, I've seen in my career, I've seen many people that once the promotional period ends, they realize that the card now has a 27% interest rate or a 28% interest rate. And if by the time of the promotional, when the promotional period ends, if they have a large balance on the card, that balance is going to start earning at 27, 28% interest. And so the change is pretty radical. So we need to be mindful of that. Whenever we apply for a credit card, we need to understand what the terms and conditions are, as well as the disclosures that they send with every credit card offer, okay? Lenders may offer better rates for secured loans because the lender may be able to recover some of their loss by repossessing or foreclosing on the collateral in the event the client does not pay the money back, okay? All right, so forms of credit. So consumer installment loans. So what is an installment loan? Installment loans are loans that have an end date. So for example, a car loan, you get it out for 3 years or 4 years or 5 years. Well, however long you decide to take the car out. You know that after you make every payment every month for that amount of time, the loan ends. You don't need to keep on making payments to it, right? So installment loans are paid over a predetermined period of time. The payment amount remains the same and the interest rate is fixed. All right, so those are two other features of installment loans. The payment is always the same. A car loan, if your payment is gonna be $320 a month, that's what you're gonna pay every month for the next 5 years, for example. It doesn't change, and the interest rate does not change either, okay? So when you're considering an installment loan, you wanna stop and ask yourself a couple of questions. Can I manage to pay this loan back? And more for an auto loan, because an auto loan, people are just thinking about the monthly payment, but many people may not think about the other costs that come with buying a vehicle, such as maintenance, such as gas, tolls. So whenever buying a vehicle, we need to consider all of those, not just the monthly payment that they're giving you. So, but can I manage to pay this loan back? Will this payment drain my emergency fund? Remember when we were talking about budgets, we need to make sure that we're able to pay all of our creditors and then have something left over, right, to save. But if the payment is larger than what our budget allows us to spend, then we're going to start chipping away on those savings or emergency fund money that you have put away. So, and lastly, can I afford repairs if the vehicle breaks down? So depending on the kind of vehicle, if you're buying used or new, that's something else that you guys want to consider. Can you guys pay for the brakes and maintenance, right? Now, credit cards are revolving loans, and that's the other kind of loans out there. A revolving loan is a monthly, it's a loan where you have a monthly payment that may change over time for two reasons. One, the interest rate is variable. So the interest rate could drive the payment up or down, or your the usage, right? So with a credit card, the more you use, the higher the payment, right? And it's a minimum payment, right? So there's two factors that drive down, up or down the payment on a revolving loan: usage and rate. Credit cards are the most common revolving loans nowadays. Credit cards are a line of credit usually not secured by any collateral, which we just discussed before, okay? Now, what other forms of other loans are out there? So we have mortgage loans, and these are very important to mention because I want to say that everyone's biggest investment will probably be their home, right? If somebody doesn't have a portfolio, an investment portfolio out there, then probably their biggest investment will be their home. So what kind of home loans are out there? A mortgage loan, which is a loan for a purchase of a home, and they usually are fixed or variable loans, fixed rate or variable rate loans, mortgage loans out there. You can also have a home refinance loan, which is also a mortgage, but it's coded differently. It's coded a home refinance because that means that you're paying a loan off with another one. I'm sorry. So loans that pay off an existing home loan with another loan, right? And then lastly, home equity loans. Home equity loans are loans based on the value of the property. So loans secured by the resident of the borrower, the amount of equity available is the value of the property minus the debt. So if you have a property that you owe $200,000, but in the market, the property is worth $300,000, that means that you have $100,000 available equity on your home because the property is worth more than what you owe, okay? And then based on that amount of available equity, you can take out a loan or a second mortgage using that equity for like home improvements or debt consolidation or many other different reasons, right? All right, so what other features do loans have? So fees and interest. Fees are the amounts charged by financial institutions to review an application or service the account. So many of these fees and some of these fees Affinity do not have, but I just wanted to mention them because I'm sure that you guys have loans with other institutions. So I want you guys to be aware of what's out there. So usually to review an application or an application fee, they come with like loans that are kind of like larger for home loans mostly. And the reason why there's an application fee is for two reasons. First, because a mortgage loan, there's a lot that needs to happen around a mortgage loan. It's not a straightforward process. There's a lot of documentation that needs to be provided, a lot of different approvals, an appraisal, the survey, the taxes. There's so many different things, wheels that need to turn the right way for a mortgage loan to happen, that usually the application fees charged at the beginning so that the borrower is serious about getting the loan and not just interested in starting a process, having a whole bunch of people work for you or work for the borrower, and at the end of the day say, you know what, never mind, I don't want it. So those are kind of like application fees. Maintenance fees and late fees are kind of like standard with across the industry in regards of making a late payment or some maintenance fees for some loans. Not like I said, Affinity does not charge maintenance fees on their loans, but they do have late fees, which is kind of like a standard in the industry. Okay. Now, interest is the amount of money a financial institution charges for extending the credit. Interest rate can be either variable or fixed. And as I mentioned before, a fixed rate is an interest that never changes, which leads to the payment never changing. So a fixed rate is a rate that remains the same throughout the term of the loan. A variable rate is the rate that may change during the term of the loan as described in the loan agreement. Now, a variable rate, depending on how the market is doing and the rate posted by the Federal Reserve, prime, that will determine if the rate will go up or down, okay? Now, credit worthiness. When I mentioned before, whenever we are ready to purchase a property, for example, there are we want to have good credit. And when applying for a loan, the bank, the financial institution, or the lender will review different factors on yourself. And banks and credit unions and financial institutions are in the business of something called risk mitigation, which is we want to make the best loan out there for the best client because we know we're going to get paid back, right? And so every financial institution, they want to do their due diligence before they say yay to a loan. They want to approve it, right? So they will be asking the 5 C's of credit, which are these 5 different C's will actually determine if you will be a good candidate for the loan or not. So the first C will be character, and this is determined by your credit score and credit history. As I mentioned before, having good credit is going to open a lot of doors for us. So character will be determined by your credit score or your credit file, right? And if you have good payments to other creditors, if you're never late, if you maintain your balances low compared to your limits, you will probably enjoy good credit. Now, if you've been late, if you have foreclosure, if you have a repossession, collection accounts, that also will have a negative impact on your credit report or your credit score, okay? Next, capacity, which is based on your income and other financial obligations. Will you be able to pay back the loan? So capacity is pretty much your pay stub. How much are you making? And what are your other loans or obligations out there? And can you afford it? Can you afford paying the loan I'm about to approve you back, okay? Next is collateral. Collateral is, as I mentioned before, is can you put something up as something valuable as security for the loan? So do you have any tangible assets that can be claimed if you don't make the payments? And this could be a car loan, right? Or cash. If you have cash in your bank accounts, banks can make a loan using some of that cash as collateral for the loan, okay? Capital, do you have any savings or assets that can be claimed if you don't make any payments? So same as collateral, capital will be the cash part of it, right? Something of value that you can put up as collateral. Lastly, conditions. How do you intend to use the money? And that's always very important for any institutions to know because they want to know perhaps there's another loan better than what you're thinking you're going to get, right? So let's say you're applying for a personal loan because you want to do some home improvements. So once you disclose that you want to use some of the money from the personal loan to buy, I don't know, windows or change the floor, then at that point, the representative could tell you, you know, a home equity line of credit will be more beneficial because it's not like you get the money up front, you pay as you go, whatever you need. The rate is very low, and usually home equity lines of credit are used for home improvements, okay? All right, so a credit score. So what items are considered calculating your credit score? So payment history is the most important, 35%, okay? And why is it important? It's because payment history dictates how well you behave with other creditors. So if you're making your payments on time and you're never late, you're gonna enjoy very good history. If you don't pay on time, you have collection accounts or you have defaults, then that's also going to show on your credit, and that will have a negative impact on your credit. Next, 30% will be amounts owed, which is what I mean when you want to keep your balances under 30% of your limits. So if you're able to maintain that balance of 30% or under, your credit score will be getting the most points out of the accounts that are being reported. Next, length of credit history. The earlier we start getting our credit established, the better, okay? But a lot of people use the technique of paying off a credit card and closing it out as a way to get out of debt or improving their score. And what they're actually doing is they are harming themselves when they do that. Because what happens is that, going back to credit history, if you have an account that is very old and you decide to close it out, whether you're making a payment or not, you decide to close out the card, you just erased all of the payment history that the card had for you for the last 20 years. So you want to avoid that. If there's a card that you really don't want to use because it has a high interest rate, because you just don't like it, it doesn't have any rewards, for example, but you've had it for a long time, pay it off, put it somewhere in your household, in a drawer. Don't bring it out with you because you don't really want to use it, but don't close it out. If you do close it out, then as I mentioned before, you're pretty much wiping out the history that you've had with the card, and that's going to hurt your credit instead of benefiting them. Next, 10% will be new credit, and this will be the new accounts that we will apply depending on what kind of accounts we get. So if we are applying for a lot of credit cards compared to personal loans or installment loans, right? And lastly, types of credit in use. That's kind of like, what kind of mix do we have? Is it a 50-50 mix? Is it more credit card heavy or more installment loan heavy, our credit, right? Now, I've been asked many times, what do I need to do to get good credit? Do I need to have the same amount of credit card loans versus installment loans, or how can I get good credit? And the credit agencies have a different way of scoring depending on the person, how long they've been employed, their credit payment history. So I wouldn't be able to tell you that having a 50-50 balance is the best thing. I've met people that have had over 800 score, all on credit cards. They've never had, or at the moment when I saw their credit, they didn't have any installment loans open. And I've seen it the other way around too. I've seen people with fantastic credit based only on installment loans and no credit cards, or perhaps one credit card. So it's really hard for anyone to say what would be the right mix. But having one or perhaps one of each, in my experience, it has helped. But I just don't want to say that it's going to provide the best score, because also there's other factors involved in when they compute your credit score. All right, so what are the ranges for your credit score? So usually the ranges go from 300 to 850. And there are 3 bureaus or 3 agencies that what they do is they compile all of the information provided by your credit card companies on your behavior. So if you're making payments on time and you're never late, that's what the company, credit card company, is going to report out to the creditors, and they compile all this information, and at the end they generate a report with your score. Okay, so if you have a score between 300 and 619, all the way to the left, right? That means that you pose the highest risk for any institution because you don't have good credit, right? And there may be 0% of you getting the loan. So they may ask you to apply with a cosigner, or pretty much say, we're sorry, we cannot approve you. Then if you start going towards the left, towards the right, I'm sorry. When you're fair, you're between 620 and 679. And as you guys can see, it's start improving, right? So if you're around 79 or 680, you're already at 50%. So that means that there's a 50-50 chance that you'll get the loan by yourself, or that they may ask you to apply for with somebody else. Now, at this point, you may not be getting the best rates being offered, but still you'll be able to get the loan. If you keep going to your right, from 680 to 739, you consider to have good credit, and 740 and above will be excellent. And when you're at the excellent level, as you guys can see, there's 100% chance that you'll get the loan by yourself because you pose the lowest risk to the financial institution. And not only that, you'll be getting the best rates that they offer, okay? Now, the rates may be higher if you're towards the left. If you're at the 50% mark, for example, because the bank they're taking a risk on approving you for the loan. So they will want to charge a little more interest because of the risk they're taking, okay? How to get a copy of your credit report. So this website I love is annualcreditreport.com. And at this website, you can access your credit score. It's kind of like a portal for you to access from all three agencies, from Experience, TransUnion, and Equifax, okay? And when you get the information from Annual Credit Report, they're not gonna sell you any credit monitoring services or anything like that. There's other websites out there that they will. But at this website, if you guys wanna take note, you'll be able to get your credit report. There are, we are allowed as citizens, we are allowed one free credit report a year from each one of the agencies. So there's a couple of ways that you can do it. You can get the report from annualcreditreport.com. You can call, or you can contact the agencies directly. And I've actually added the website here for you to access the information and contact the credit report directly, the credit agency directly, if you want to get the report, okay? Now, a quick checklist for credit decisions. So this is kind of like the questions that you're going to be asked at the bank or the financial institution once you're ready to apply for a loan. And many of the answers to many of these questions will be evident in the documentation that you provide. But it's always good to have the answer readily available in our mind, because that will show that we are proactive and we are on top of our finances. So you should know how long have you been at your job, right? How much money do you make each month? What are your monthly expenses? How much money do you make in your accounts? Do you have in your accounts? Have you had any credit in the past? How many credit accounts do you have? Have you ever been denied credit? Have you ever filed bankruptcy? Have you ever made late payments? Okay, so those ones that talk about credit, bankruptcy, late payments, or how many credit accounts you have, the information will come up eventually once they pull your credit. But it's always good to know the answers to these questions to show that you are prepared and you know where you stand financially. Now, a couple of questions or tips before applying for credit. This is something that you guys should be asking yourself before you apply for the actual loan. Do I need this loan and do I need it now? Can I wait? Can I wait to have cash or more cash to pay for what I'm buying? Okay. Remember what I mentioned before, we need to identify what's a need and what's a want. And when you're buying something and it's a want, and more if it's on credit, you want to ask yourself, is this something that I can wait for, or is this something that I need to have now? Then how much more will I pay if I buy it on credit? And that's not only the interest. If you're buying a vehicle, how much are the vehicle upkeep costs, right? Can I afford the monthly payments? What is the total cost of the loan? So it's the principal plus interest. What is the final figure that I'm going to end up paying? Are there any fees, right? What is the interest or APR, annual percentage rate? And finally, you want to identify if this is a want instead of a need, okay? Lastly, tips to manage your credit. So managing your credit is very important. Following these tips will help you with a good credit score. So these are things that you should be doing to, if not already, if not that you've already been doing it, to maintain a good credit. So if possible, pay off the entire credit card balance each month. That way you don't have to pay interest, okay? You will still be getting the payment history because you're making payments. It's just that you wouldn't be carrying a balance, but that's fine because for those of you who may perhaps don't like to pay interest, this will be the best thing, to pay off the credit card each month. Try to pay more than the minimum required in order to reduce the total interest paid. So quick example, if you purchase a TV for $500 using a credit card at 15%, and 15% right now is really good. Usually credit cards are around, the average is around 18%, and they may go up to 27, 29. So 50%, it will cost you $789.59 and take you about 6.5 years to pay it off. Only if you only pay a $10 minimum monthly payment. 6.5 years, imagine, for a TV that costs you $500. So if you want to try to send as much as possible, not just the minimum required. You want to pay on time to avoid fees and protect your credit. What kind of fees are there if you don't pay on time? Well, late fees or over the limit fees. So you want to avoid those, right? If you cannot pay on time, you want to call your creditor immediately and explain the situation. A lot of people don't do this. They may feel ashamed or maybe they don't care, but when you cannot make a payment, you want to have that communication line open with your creditor because they may have some kind of program that can help you out, put you on a payment plan, perhaps forgive a couple of payments, but you will not know this until you give them a call and explain. So if you're one of those persons who perhaps have fallen into hard times and have credit cards, if you're unable to make those payments, it's always good to give them a call and get in touch with them. Finally, think about the cost between purchasing an item with cash rather than with credit. And there's extra costs, right? As I mentioned before, we want to have a credit file established, but we also want to be responsible, okay? All right, so this concludes my presentation today. And I want to thank everybody for staying in the session, and thank you for paying attention. At this point, I would like to open up the Q&A part of the webinar. If you guys have any questions, please feel free to ask them. A couple of things: in about 20 minutes or so, I'll be sending out an email thanking you for attending. And in the email, you will receive a link to be able to rewatch this presentation, as well as the link to register for next week's webinar. So hopefully you guys will be able to join me in next week's. Let me take a look. Next week is working in a gig economy. That's going to be the topic next week. So for those of you looking to make a couple of extra bucks on the side, or perhaps you're looking to change careers and maybe drive Uber or Lyft, I will be talking a little bit about what is it to work in the gig economy, okay? Let me take a look if there's any questions. There is one. Excellent, thank you so much for the question. When do you recommend requesting a copy of the credit report? Does it lower your credit score? Fantastic question. So I'll answer the first part of it. When do I recommend requesting a copy of the credit report? Pretty much there is no recommendation. You can pretty much do it any time of the year. What I would do, what I would suggest though, is if you're going to request your credit report, and you've never done it in the past, you're gonna do it for the first time, you wanna get all 3 credit bureaus reports in one shot. Because sometimes, since we are allowed to have one report a year, some people that I've met throughout my years in banking, they do, for example, in the spring, they'll do Experian, then they request in the summer, they request Equifax, and then in the fall, they will request TransUnion. And that's fine. But if you've never done this before, you want to get a full picture of what's being reported. So when you request all three of them in one shot at the same time, you are going to get your full financial picture, because there may be credit card companies out there that report to one and not the other two, or report to two agencies and not the third one. So if you happen to put the credit report only from the agency that this credit card company is not reporting to, guess what? You're not going to see that information in your report, and you may not be able to see the full picture. Okay. And now the second part of the question is, does it lower your score? It does not. When you request your credit report, when you requested, the agency or annualcreditreport.com will understand that you're requesting your report for information purposes only. Your score will be lowered if you are applying for credit, if you're actively applying for credit. So when you're not pulling the report, but a financial institution is pulling it, that means that there is an intent to get a loan. And that's when you would be dinged in your credit report. Then your credit report or your credit score will be lowered just a little bit if you apply for a loan. If you apply, like, for example, using sites such as Credit Karma or annualcreditreport.com, when you get that kind of information, it does not lower your score because you're not actively looking for a loan or asking for money. Okay. Thank you so much for the question. All right, let me just take a look. Don't see any more questions at the moment right now. So, oh, okay. So there is a question. Are these presentations available in Spanish? Thank you so much for asking. I'm bilingual. I do not present, I don't present these topics in Spanish to our membership because we haven't actually gotten too much traction with the Hispanic population in regards of engagement, right? But I do, all of these presentations I have translated into Spanish. So if you would like the presentation translated into the Spanish language, I can send it over to you, or I can, we can meet up, well, not meet up, but we can set up a Zoom session and I can go over the presentation with you in Spanish if you need to. Usually we don't do it as a weekly webinar because the engagement is not where we want it to be. It's not as good as with the English population, but I'm available and I'm bilingual. So if just let me know if you would like me to go over a presentation with you in the Spanish language, I'll be more than happy to do so. All right, very good. So with that said, I don't see any more questions being asked. I want to thank everybody for attending this evening. I hope it was informative and I hope you guys liked it. I hope to see you guys next week for the working in a gig economy topic. And you guys have a wonderful evening, okay? Thank you so much. See you guys next week. Bye-bye, everyone.